Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Thursday, September 10th of 2020. We've got several headlines moving markets today, so let's get right down to our daily updates, and thanks for watching. So our first topic of the day, Congress is ultimately, this is their last chance to get anything done. Today you have the Senate. They need 60 votes, if you will, to pass anything for the CARES 2.0 Act or the HEROES Act, whatever they decide to ultimately name it. And if they get it done, ultimately, I believe a deal will get done, but I don't believe a deal will get done before November 3rd. And that's sort of a political date specifically. The House has their ability to make something happen next week when they come back from recess, but ultimately, today's the Senate, next week's the House. And I don't believe that they're going to get anything done materially between now and the November 3rd election. And I think there's a lot of political motivation behind that. But unfortunately, in the fray, you have the American worker, right? You have those that are claiming unemployment in the service sectors, which has been hit so hard. So the unemployment claims and the additional stimulus benefits and the checks that are needed, it doesn't look like that's going to happen for the next month and a half. So markets are paying attention to this. We're going to pay attention to this. But ultimately, markets do see through the fact that it's either going to be 300 billion, which is what being proposed, and the minimum, which is sort of an opening bid, to 3 trillion. Okay, so that's a big picture. Somewhere in between now and year end, probably right before Christmas, there'll be another round after the election, Congress making a deal. Now, what do the markets see and why that's important? Well, ultimately, we had CNBC this morning had Alan Greenspan, the former Federal Reserve. If you remember in the 90s, he was basically the Federal Reserve chairman that provided sort of that backdrop, if you will, to the great go-go 90s. If you recall, from 1995 to 1999, the equity markets was up about 28%, S&P 500. On average, year over year over year over year. So that's 4 years in a row. So just do the math on compounded 28% year over year. That's when a lot of people became millionaires in the late 90s. What was behind that was backed by the Federal Reserve. Don't fight the Fed. They helped create what became the dot-com bubble of the asset valuations. Now, are we back to the future, if you will, with are today's Fed chairman and ultimately supporting asset prices? Well, we're in the early stages of getting out of and stemming off a recession, right? Thought it was going to be another depression, recession, coronavirus is going to shut down essentially not only the United States, but the rest of the world. We're coming out of this, and what we're learning and what we're finding, economists and markets are ultimately seeing through, is that we may not have had the best course of action by way of policymakers by shutting down the economy. Ultimately, we had a strong economy. January and February, we were at all-time highs on all-time lows on unemployment, all-time highs on markets, and all-time highs on the U.S. economy hitting on all cylinders. We ultimately were just hitting our stride. We get the coronavirus, and then you get ultimately, 3 trillion and 4 trillion respectively from Congress and the Federal Reserve in terms of aid and backstop and stimulus and all of this in their U.S. economy. So about $7 trillion to basically pick up the slack of the third quarter GDP. And we had the second quarter GDP was a terrible number. The third quarter right now, which we're in right now, is going to be an unbelievable number, probably 20 to 25% quarter over quarter, year over year increase just for this particular GDP snapback. What does that ultimately mean is that the Federal Reserve Chairman ultimately said this morning that he believes that right now it's not inflation is the issue, it's the deflation is the issue. So that's signal to everyone in the equity markets that the Federal Reserve is more focused on providing a backstop and supporting asset values. Now, keep in mind, they have a dual mandate, right? One is inflation, staying on top of inflation, but right now they're trying to create inflation to get us an escape velocity outside and grow the economy, as well as their other mandate, which is employment. And so they've got a lot of work to be done over the next 24, 36 months going forward, because as I've said before, the employment picture is not going to be pretty on a go-forward basis because of a lot of jobs are just not going to come back, right? There's going to be the forced retirement. There's going to be companies that are getting rid of unions because they don't have the ability, or they have the get out of jail free, if you will. I know one big company that owns a big hotel in Beverly Hills, they fired everybody and they were union. And they're going to rehire non-union. So this is a huge systemic change on a go-forward basis in the employment picture. And there's a lot of turnover. It's going to be very choppy and turbulent. Another thing, let's talk about the employment picture today. The weekly jobless claims missed their estimates. And that's true, but another report, that was from CNBC, by the way, but another report also came up with the continuing claims were in line with the 884 estimate versus the 850. It's pretty close. It's actually one of the closest sort of numbers that we saw from economists predicting versus what we actually got. So what I'm going to say is be careful where you get your news. I got it from CNBC today. It wasn't the best sort of positive information on employment. And ultimately, they had that front and center. If you followed my daily updates, like so many have had before, if it's positive news, CNBC will bury the story. If it's a negative news or slightly a news story that they can spin, they will put it front and center. Just be careful of that because markets see through that. Ultimately, there's journalism and there's information and affirmation. So be careful that we're not in our social media, getting our affirmation of things that we like or things that we sort of feel comfortable with because it's just affirming what our own beliefs are versus true information. That's why I started this daily update of what markets are paying attention to. It's sort of cutting through the information versus affirmation that we're seeing out there. Ultimately, this is a news story that could be spun either which way, and the markets are taking that in stride. So we'll also look at for employment numbers tomorrow. So our final thought is, all eyes again on the Federal Reserve. So we want to make certain that we pay attention to what the Federal Reserve is ultimately going to say in the short term, but do in the long term. So ultimately, you always want to basically follow the Federal Reserve because it's not billions, it's trillions of dollars that are ultimately in the marketplace, right? And so you don't ever fight the Fed. That's number one rule in the wealth management industry as we manage money professionally for clients. That being said, the easy part is sort of following what the Federal Reserve's doing when they first do a support or they're first entering the market to sort of stem off the recession or even Great Depression, if you will, which they've done in years past when the monetary policy comes in. It's the hard part going forward, and I'm not talking in the short term, I'm talking long term. When they start taking the stimulus away or raising interest rates because they have to, because there are signs of economic stability and life and sort of growth and sort of maybe a reinflation of sorts, if you will, and the economy is sort of picking up and we have unemployment sort of continuing to trend in the right direction, which is down. All of those factors, which is not now, this is going to be down the road, and past the election is going to give us more clarity because then we can position accordingly as to which sort of political party we need to position. If one party gets in versus the other, that could mean taxes, that could mean regulation, that could mean you have to manage and position a portfolio accordingly. So that just means economic growth could be pushed down the road. And ultimately, that means the Federal Reserve is going to be in the playing field, playing a little bit longer. So we do know this. The Federal Reserve is fully engaged, and they're completely going to be with us in supporting equity markets and asset valuations and real estate and a few other things like gold. Long term, those are real asset classes that you want to hold on. Those are long dated asset classes that you want to hold on to for the reinflation trade. So now between now and then, there's going to be some fits and starts in the economy, and that's what's ultimately going to create the volatility in the equity markets. But in the short term, we look for opportunities, but long term, you just want to follow what the Federal Reserve's doing. And Alan Greenspan reiterated that and confirmed that today earlier on CNBC. So that's our update today. Thanks for watching. Again, like and subscribe and share our YouTube channel. We have over 1,000 subscribers, so we really appreciate that. And don't forget, next week we have our election edition. So we're going to discuss a lot more with Robert Stein. He is the First Trust political strategist from Washington, D.C. So he's going to give us a little bit more insight in terms of positioning for the November election. So thanks for watching and have a great day.